Hello, I'm Rachana Shanbogue, finance editor at The Economist, and with me today is Ray Dalio, the founder of Bridgewater, the world's largest hedge fund, and a philanthropist. Ray, it's a great pleasure to welcome you to this fireside chat at the Greenwich Economic Forum. Thank you for joining us.
It's my pleasure.
Now, you're here to tell us about the long sweep of history, which you've been studying very closely, but I think it would be remiss of me not to ask you first about, the big news that we've had on Pfizer's vaccine, on the US election. Tell us a little bit about what that means for markets.
Well, the new trials indicate something like a 90% effectiveness rate. So that's great. One way or another, the virus will go away over the next year, I think. I mean, that's the evidence. And then we'll go back to relatively normal, we assume. Except we're also going to be stuck with the issues that are the virus, and I think they're the important ones, and we'll turn to those. There are three of those. The first is the debt and money issue. In other words, we have quite a lot of debt, and we're running large deficits one way or another, and we're funding that with the printing of money. So that's an issue. It, raises the question: is modern monetary theory and all of that, how does that work, and what are the implications of that? Maybe we'll touch on that if we have time. But it diminishes the value of money, and it raises the value of other assets like stocks and so on, and has implication for the currency. The second one is the political one, and so we've made greater clarity there. The big thing that was and still is a problem is that we have the largest political divide and wealth divide in the country since the 1930s. In other words, there's a big wealth gap, there's a big opportunity gap, and then there's a big political gap. And how those gaps are filled or dealt with is a very, very important thing. I think I'm hopeful that the most important things for any country is to try to deal with those gaps in a united way, to not have a win at any cost type of internal battle. There's literally a risk of a civil war if that's not handled right in various ways, because there'll be limitations as to what people will give up. So, but there may be this move, and I think even I think it's a good thing that the Democrats, the Republicans might win the Senate, because I think you have a population which is two very strongly opposed ideologies, if you were to think about this red and blue states issue, although there are other issues too, and that the conflict for them, above all else, can't be dysfunctional. So that's the second. And then, of course, we still have the rise of China. The third great influence, I think, is the rise of a great power to challenge an existing power. And my suspicion is that maybe it will be dealt with a bit less confrontationally, finesse. I don't know. But peace and productivity are my two big things. And I think that the last week has been a good week in those regards.
You've touched on lots there. Let's start with debt monetization. It seems like bond yields are still low, the dollar's still relatively safe haven. At what point do markets start pricing in the sort of when do we expect to see this sort of devaluation that you've been talking about?
Well, I'm a mechanic. I just look at the supply demand. It's not ideological. Just very simply, a certain amount of debt that has to be sold, and then has buyers, and they buy for different reasons. And that has been a burden on the dollar. The dollar has been weakening, but not unacceptably so, probably even in a healthy way. But if you take the size of deficits, let's say, and you take our basic structure, of whether it's at the federal government or for the country as a whole, the fact that we are borrowing more money than we are borrowing money. So we're spending more than we're earning. And our balance sheet is deteriorating, means that there's a debt rollover issue and a challenge in selling that debt. The time will come, like a currency defense, that when you see that, it'll happen more abruptly. The way that happens is you may not be able to sell enough bonds. Even domestically, institutional investors are seeing a reduced value of bonds in their portfolio. The traditional 60-40 portfolio, for example, is giving them a return on bonds that won't meet their needs, is guaranteed not to meet their needs, and also no ability, really very little price appreciation potential, because as interest rates go down, prices go up, but there's not much. So for those reasons, there are also lesser demands for bonds, that supply of bonds, which is going to mean that the Federal Reserve and other central banks have similar situations, but particularly the Federal Reserve is going to have to monetize that debt and so on. And so from supply demand point of view, there is that it is an important issue.
And if we go back over history, are there episodes where similar sorts of monetizations, the decline of certain empires or regimes, has been overturned because of better policy? This is sort of linking to your second big factor on inequality.
Yeah, it's funny. The time that occurs to me that's analogous. It happened three times. Well, it's happened many times in history. I'll give you a few. March 5th, 1933. August 15th, 1971 was similar to April 9th this year, okay? In that, in all of those cases, there was a lot of debt and money, there wasn't enough money. And you needed to either get money by taxing it from somebody or by printing it. And taxing it had a negative effect on growth. And so on the first case, Roosevelt, March 5th, 1933, broke the link with gold and so on, and produced a lot of money. And then the stock market went up a lot because easier money is good for the stock market. The dollar went down, gold went up. Same in August 15th, 1971. I happened to be clerking on the New York Stock Exchange floor at the time. I was a kid. I mean, I don't know, a 20-something. And I heard that, the money wouldn't be accepted in Europe. And then the dollar was tied to gold, so its only value was tied to gold. And on August 15th, President Nixon ended that. I walked on the floor of the New York Stock Exchange thinking the market would be down a lot, and it was up a lot because of the effects of easing monetary policy and printing money. And the same thing happened this time around. So that dynamic has happened repeatedly. When you're late in a long-term debt cycle, the printing of money and creation of debt and monetizing it happens. And then it traditionally, it doesn't make it a good storehold of wealth. You today get a minus 1% real interest rate guaranteed, or almost a zero, depending on the country, between 0 and 1% guaranteed interest rate there in an environment which is different from that. That's a tax on wealth. And so that causes the natural shifts that I'm talking about, which in turn fill in. That the history has taught us that lesson over and over again.
Now, I'd like to move on to China because we're actually getting a lot of questions from the audience on China as well. Tell us first what the sort of main drivers are of the rise of China. Well, obviously.
State capitalism, I suppose. Began in there was the Revolution 49, and then Deng Xiaoping comes to power. And beginning in 1978, a highly regimented communist system in which there was no private ownership to speak of, was liberalized. I started going in 1984 as the guest of the only company that was allowed to look at the outside world, CITIC, and for the purpose of teaching them financial markets. And back then, it was highly undeveloped, but you could see the intelligence of the people the way they were. So the opening up, two things happened. Deng Xiaoping had opening up, and he had reform. And that was the movement increasingly to a market open economy, in which his famous statement, "It is glorious to be rich." And when asked about whether it's capitalism or communism, and he answered, "It doesn't matter if it's a black cat or a white cat, as long as it catches mice." And we began that. Since that time, per capita income has increased by 30 times. The average life expectancy has increased by 10 years. The poverty rate has fallen from 88 to very almost nothing. And abject poverty. And so that power. So if you go to China now and you see the resources, what a difference. When I first went to China, I would give as gifts $10 calculators to people, high-ranking people, and a calculator, and they thought, wow, that's a miracle device. Literally, 1984. Today, their technologies are comparable to ours and improving at a faster rate. So China is very strong in many different ways, and it has a unique culture that is working well because they've been able to allow and facilitate inventiveness, the development of the capital markets. In 2015, foreign investors could only invest in about 1% of their markets. Today, foreign investors can invest in 60% of their markets. So it's following a very classic path. They're the world's largest trading company, meaning they account for more of world trade than any country. So the development of the renminbi as a increasingly important currency, the development of their financial markets, that's what's going on in China. So people, I think, need to understand it better and not let misunderstandings stand in the way of their exposure, because we're now in a world where I think you need to be thinking about diversification, because when you have a rising power through history, challenging existing and perhaps declining power, you're in a situation where your portfolio needs to be diversified and you need to understand those relationships.
Thank you. Actually, one of the questions from the audience was exactly that, how to think about investment allocation given these big changing trends. I wanted to ask you about state capitalism, and you're right to say, of course, that China's financial markets have opened up, but is there a point at which the state might start becoming a problem and might impede China's growth? I guess I'm thinking of Ant Group's suspended IPO, which seemed to perhaps reflect some sort of last-minute regulatory troubles.
I've had the opportunity over the last 30 some odd years to deal with Chinese regulators, and I know what they're like. I have found them to be very reasonable, logical, informed people who want to make progress and are doing the things that almost always that I would have done if I was in their shoes. But they go at a certain pace, and there has to be a process for doing that. They don't want to rush ahead. And I should say that regulations are always difficult for any regulators. When I think of our regulators in the 2007, 2008, they were not tight enough, and they got criticized for not being tight enough. Then it's too tight. And so nobody's going to be pleased of exactly. I think it would be a very serious mistake to take that and interpret that as a whimsical, inappropriate type of regulatory environment that threatens one's investments in China.
And another question from a member of the audience: What does decoupling mean, given the sort of the relative? If you see America relatively declining and then China sort of rising, is decoupling good for either economy?
Decoupling is essential for both economies because of the geopolitical risks that happen. History has shown that when there's a rising power challenging an existing world power, the United States, 1945, we had the American world order based on the American dollar and the American economy, and that is changing. And so history has shown that 16 times there were rising powers challenging an existing power, and in 12 of those times they had wars, and in any case they can't be vulnerable. Supply lines can't be cut off, or technologies can't be cut off, and so on. And that is driving to both economies and both countries to have self-sufficiency. China has now gotten to the point where it's caught up and it has technologies and so on, and it could develop within China. And so you're going to see this world, you will see decoupling, and where there is overlap, you will see tension. Now, economically, it's not good. Economically, for the world, it would be better if there was the free sharing of such things, and that you could build on each other's efficiencies and intelligences. But anyway, that'll give way. And so it'll be a drag, all things considered. But we'll be playing with that line. What will it mean for who can invest where and who can use what technologies? That'll have to be determined. There are basically 5 types of conflicts that the United States will have and is having with China. We have a trade war. We have a technology war. We have a geopolitical war of sorts, the region and how that's being dealt with. We have a capital war. We're emerging in a capital war. Something like 35, 40% of all important IPOs and listings will come into by China on Chinese markets. So there'll be movement that way. And history has shown us that all of the major empires had financial centers, the world's great financial centers. That was Amsterdam in the Dutch Empire, and London in the British Empire, New York in the American Empire. We are going to see more of that over there. So there's a capital war issue, who can list where and so on. And then, of course, there's a military competition. There will be a competition for spending, and it'll be dependent on how strong the countries are to be able to spend. So when we think about, let's say, the budget questions, defense will play an important role, and there could be military issues. There's a lot to argue about, and there is a general belief that you can have your domains. It's an intertwined world, but if you have an Asia and Chinese operating in one way, and the United States and a bit of, and there's a mutual respect that can be achieved, I think that's the best possible outcome, all things considered.
Ray, we've only really skimmed the surface of this discussion, but unfortunately we're out of time. Thank you so much for joining us, and it was a pleasure to speak.
Thank you for having me.